States is set to weaken and remains low in China. Although energy constraints have eased somewhat in the euro area, recession risk is high. Additionally, a number of developing economies face debt distress, exacerbated by tighter global financial conditions. Policy normalization has accelerated, and monetary conditions are likely to tighten further to ensure that inflation declines from its current high rates. With long-term borrowing costs high and fiscal positions extended, there is little policy space available for major counter-cyclical efforts to increase economic growth. In several economies, including South Africa, ongoing consolidation of fiscal positions will support disinflation. Asset values in major markets have also declined sharply, and investor appetite for riskier assets remains weak. Taking these and other factors into account, the SAP's forecast for global growth in 2023 is revised lower to 1.9%. The International Monetary Fund's October forecast for global growth is 3.2% in 2022 and 2.7% in 2023. We now expect the South African economy to grow by 1.8% this year. Despite considerable volatility in monthly indicators, GDP growth of 0.4% is still expected in the third quarter. Fourth quarter growth is forecast to be only 0.1%, largely due to record load shedding. Over the medium term, and despite stronger private investment, the forecast takes into account lower commodity prices, higher inflation, and interest rates. On the supply side, the forecast incorporates an assumption of increased load shedding, which could deduct 0.6 percentage points from GDP in 2023. As a result of these factors, the economy is forecast to expand by 1.1% in 2023 and by 1.4% in 2024, which is below previous projections. GDP growth of 1.5% is forecast for 2025. With a low rate of potential, our current growth forecast leaves the output gap slightly larger in the near term before closing in the third quarter of 2023. After revisions, the risks to the medium-term domestic growth outlook are assessed to the downside. Commodity price movements in recent months have been mixed, with oil prices relatively stable and export prices lower. Compared to September, our oil price forecast is broadly unchanged, averaging $102 per barrel for 2022 and $92 per barrel in 2023. South Africa's export commodity price basket has come down from earlier peaks. As a result of weaker export developments, the current account balance is expected to be negative 0.2% of GDP this year, falling to negative 1.5% in 2023 and negative 1.9% in 2024. The current account balance in 2025 is expected to be negative 2.1% of GDP. Although near-term fiscal risk has eased on the back of better tax revenue, a weaker commodity price trajectory than currently expected could increase risk. Financing conditions for rand-denominated bonds have been generally tight and more volatile in recent months. 10-year bond yields currently trade at about 10.7%. Policy normalization in major economies and the slower growth in China have contributed to depreciation of many emerging market currencies, including the rand. The implied starting point for the rand forecast is 17 rand 76 cents to the US dollar, compared with 16 rand 91 cents at the time of the previous meeting. Globally, economic growth is slowing, and prices have fallen for some goods and transport services. However, price pressures continue to spread from goods to services and wages. Our estimate for inflation in the G3 is revised higher to 7.3% in 2022 and 4.1% in 2023. The forecast for 2024 is unchanged at 2.1%. Even though South Africa's fuel price inflation for the year remains exceedingly high, some easing of global oil prices has led to the forecast revisions in the last few MPC meetings. Fuel price inflation for this year is now forecast at 33.3%, falling to 0.8% in 2023. Local electricity price inflation is slightly higher at 10.7% in 2022, 9% in 2023, and is unchanged at 10% in 2024. Global food price inflation has declined. However, local food price inflation is revised up due in part to the weaker exchange rate and is now expected to be 8.8% in 2022. Food price inflation is revised higher to 6.2% in 2023 and is unchanged at 4.2% in 2024. The bank's forecast of headline inflation for this year and next is slightly higher at 6.7% and 5.4% respectively. In 2024 and 2025, we expect headline inflation of 4.5%. Our forecast for core inflation is unchanged at 4.3% in 2022 and is higher than previously expected at 5.5% in 2023. The forecast for 2024 is unchanged at 4.8%, and 4.5% is projected for 2025. Services inflation is broadly unchanged and continues to be driven by expected spillover effects and steadily rising unit labor costs. Core goods price inflation is forecast somewhat higher at 5.7% for next year. The forecast for average salary growth is broadly unchanged. Risks to the inflation outlook are assessed to the upside. Despite easing of global producer price and food inflation, Russia's war in the Ukraine continues, with adverse effects on global prices generally. The oil price market is expected to remain tight, with upside risk to prices. Electricity and other administered prices continue to present clear medium-term risks. Given low public sector wage assumptions and high petrol and food price inflation, considerable risk is still attached to the forecast for average salaries. Higher than expected inflation has pushed major central banks to accelerate the normalization of policy rates. It has tightened global financial conditions and raised the risk profiles of economies needing foreign capital. G3 interest rates levels for the forecast period are now expected to be significantly higher than in September. On balance, and with few exceptions, capital flows and market volatility will be elevated for emerging market assets and countries. While the rand has recovered somewhat, it has depreciated by about 7% year to date against the US dollar. Inflation expectations increased strongly over this year and remain high. Expectations of future inflation surveyed in the third quarter of this year had earlier increased to 6.5% for 2022 and 5.9% for 2023. Expectations for inflation in 2022, based on market surveys, has increased to 6.8%. By contrast, long-term inflation expectations derived from the 5-year break-even rates in the bond market have moderated to 5.27%. In the second quarter of this year, inflation breached the upper end of the target range and is forecast to remain above it until the second quarter of 2023. Headline inflation is only expected to sustainably revert to the midpoint of the target range by around the second quarter of 2024. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. As usual, the repo rate projection from the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Against this backdrop, the MPC decided to increase the repurchase rate by 75 basis points to 7% per year with effect from the 25th of November 2022. 3 members of the committee preferred the announced increase. 2 members preferred a 50 basis points increase. The level of the repurchase rate is now above the level prevailing before the start of the pandemic. The revised repurchase rate remains supportive of credit demand in the near term, while raising rates to levels more consistent with the current view of inflation and risks to it. The aim of policy is to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. Guiding inflation back towards the midpoint of the target band can reduce the economic costs of higher inflation and enable lower interest rates in the future. Achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains would enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, monetary policy decisions will continue to be data-dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. The bank will continue to closely monitor funding markets for any stress. This concludes our statement for today. And at this stage, I would like to invite members of the media here present for the first time since January 2020 to pose any questions that they might have. Who is the first volunteer? Please identify yourself and the media house you represent, and then you can pose your question. There is a battle of the two ladies. Renee?
I've got the mic, Governor. Thank you very much. I'm Renee Volgraaf from Bloomberg News. Governor, at the October Monetary Policy Review, you mentioned in your speech that the SARB is not ahead of the curve on policy normalization. After today's move, where do you see the SARB in terms of being ahead of the curve or not, or behind the curve on policy normalization?
Prinesha?
Governor, it's Pranesha Naidu from Bloomberg News. I have quite a few questions for you. Firstly, you have for the first time given us steady state forecasts, and in this, you have a repo of 7%. What exactly does this mean? And also GDP growth at 2.5%. I then want to know whether you still see the policy stance as accommodative. Inflation, your forecasts, you said, are slightly higher for the next year or so. It appears sticky. How concerned are you about persistence and the potential second round effects? And how assured are you that inflation expectations will come down to the midpoint over the forecast horizon? And two questions related to the Federal Reserve's minutes yesterday. They signaled they're probably going to cool the pace of hikes, shifting to 50 basis points in December. How, if anything, would that influence the MPC's thinking or deliberations when it comes to the repo rate? They also flagged the risks of over-tightening. So I just wanted to find out from the MPC a bit more how you're thinking when it comes to weighing the trade-offs between fighting inflation, growth, and the growing burden on consumers. And that is it for me. Thank you.
Are you sure?
It depends on your responses, I guess.
Is there another one? Let's take the last one. Chris, you are in steady state, my friend.
Hi, Governor and Governors. It's Kopano Gumbi from Reuters News. Just following up a bit on what my colleague Pranesha just said, I'm curious about your views on how inflation has now become more of a domestic challenge than when we started the pandemic, and it was assumed that inflation would be imported, especially when we look at how the numbers came out yesterday with inflation going across the basket, and what you think your response might be going forward relating to that. Thanks.
Thank you very much. Renee, are we ahead of the curve? Are we on the curve? Are we behind the curve? You could only tell that with hindsight. Because remember, we determine policy based on our inflation and growth outlook and the risks attendant to that. Since the September meeting, many of the risks that we had identified had materialized. Amongst those risks was faster tightening of policy by the advanced economies. It was inflation in the advanced economies remaining sticky, and it was. It was the possibility that the tightening of policy, faster tightening of policy by the advanced economies, central banks, would result in depreciation of the currencies of developing economies. And we have seen those materialize. And with that, you have to recalibrate policy accordingly. So we take a view that the policy adjustment that we have made now is consistent with the forecast and is consistent with the risks that are attendant to that forecast, and that we continue to be data dependent, and as new data comes in, we will recalibrate policy as appropriate. And that is how we think about this. Vanessa, the stuff about the policy stance and whether we think that the policy stance is still accommodative. We believe that the stance that we have will still support credit growth, whilst at the same time dealing with the inflation that is ravaging the incomes of South Africans. And so, where we, the inflation figure came out yesterday as, at 7.6, and the policy rate had been adjusted with effect tomorrow to 7%. So if you look at today's inflation, the policy rate is still negative in real terms. That says that it is accommodative. It is another though, because for next year, we are forecasting inflation of 5.4%. And so on a forward-looking basis, we would have just turned marginally positive to the tune of 1.6%. And that becomes important because that is roughly the policy horizon of 12 months, which means that the calibration of policy now should have effect on the inflation outcomes of the following year. And of course, like all things in economics, other things being equal. And those other things being equal in our case here are the risks that we had identified. And should those risks materialize, we are going to then have to reconsider policy as the data actually comes out. Is inflation in South Africa persistent? Can't say definitively that it is persistent. What we can't say is that it is temporary. We can't say it is temporary, because then if it is temporary, monetary policy should do nothing. But we are seeing evidence that inflation had been rising over the past 12 to 18 months. Give you an idea that in 2021, when we experienced growth of some 4.7%, the output gap was still marginally negative. Actually, not say marginally, because it was negative to the tune of 2%. But what we had was that actual growth was faster than potential GDP growth. We saw the same situation this year, that actual growth is forecast to be faster than potential GDP growth. It's the same story into 2023, even as growth slows down, that actual growth will be faster than potential growth. The result of that is that we expect the output gap to close in 2023. A closed output gap says to us that inflation might soon catch up with us, and you can't wait until you see that the output gap had closed, but based on your forecast, you then take a view about that. Secondly, we have seen that there has been this narrative in South Africa that says, oh, this inflation is just external, it's just supply shocks and so forth, and you must look through it, which is what we did from early 2021, that we looked through these shocks until we saw that there was evidence that inflation was beginning to be broad-based, which is when we started to adjust policy in November. And so, if you strip out the two items that are said to be the shock, being energy prices and food, we still find that core inflation has risen significantly from what we had seen over the past 12 to 18 months, and yesterday surprised when it hit 5%. If anybody wanted a measure that inflation was beginning to be broad-based, that would be it. Unfortunately, there is nothing we can do about October's inflation or September's inflation. That is water under the bridge. We can do something about future inflation, And the response of the MPC with this policy decision is to respond to the future pressures that could build up with inflation. And this is necessary because South Africans are complaining about the rising cost of living, and it is important that the central bank continues to deploy its instruments to tame the monster of inflation. Inflation expectations, is it that case that we want them to go to 4.5%? Exactly, you got it. That is where we would like to see inflation and inflation expectations to be anchored closer to that midpoint of the inflation target range, because then it will make the decision making in this economy much easier and much more certain. And decision makers in this economy can plan with certainty, knowing that inflation is under check from the central bank. Minutes of the Fed, if you ask the Fed what they think of the statement of the MPC of South Africa, they will refer you back to us. So I will not talk about their minutes. There is something, though, that comes which says that there could be a risk of over-tightening. Of course, there could be a risk of over-tightening. That risk does not exist now because inflation, she is here with us. And with inflation here with us and projected to remain outside of the inflation target into next year, we can't say that there is a risk of tightening as yet. But economic history does offer important lessons. That in the past, when policymakers took a view that said that there is a risk that we might be over-tightening and under-tightened, inflation ran ahead of them, and then central banks found themselves having to correct and raise interest rates even more aggressively, thus choking economic growth. Let's be clear. The current elevated levels of inflation are not good for growth. They undermine growth. And any central bank that would like to live true to its mandate of price stability, and in our case, price stability in the interest of balanced and sustainable growth, we got to understand that unless we tame the monster of inflation, we cannot have balanced and sustainable growth in this economy. Kopano, I think that in a way, in dealing with Prinesia's questions, I did also deal with the fact that we are seeing a broadening of inflationary pressures. But you did raise another issue about whether inflation is now becoming a domestic challenge. There are things that we've got to worry about. The tariffs that are demanded or sought by the price setters in the utility space, whether it is electricity, whether it is rates and taxes by municipalities, whether it is rail, but those things start to say to us that there are things that as South Africans we have got to say, wait, we can't keep on blaming inflation coming from elsewhere, that it is also here with us. In any case, even if the inflation has come from somewhere else, it is here. We have got to deal with it because it is eroding the income of South Africans. Chris Lowveld, you are in steady state.
Indeed. So we've decided to publish more of the details of our model, which we do from time to time. This time around, we thought it would be useful to talk a bit or put out the steady state long-term forecasts for the model. So in other words, these are the anchors for the model over long periods of time that the model reverts back to. So it solves for getting back to these numbers. So the steady state forecast for the repo rate is 7%, and what you need to think about is what the composition of that is. And it's very simply the 4.5% inflation target plus what we estimate the neutral real interest rate to be, which is 2.5%. And so that adds up to 7. So as the governor was saying earlier, you can have a higher interest rate, or sorry, higher inflation rate, say 6%, and a lower neutral real interest rate, it might be negative and still get to a 7% number. So over the longer term, so 3 or 4 years, we expect our rate setting to get you back to a steady state repo forecast of 7%. And the same is true of the other variables that we've released. The GDP is a useful one. It's 2.5%. So that's what we believe that the long-run steady-state growth rate of the economy actually is. And again, it serves an analytical purpose because if you then think about, well, where the forecast is now, it should tell you something about, well, what's keeping the economy from attaining that 2.5%. And of course, that's something that we talk about in the statement and in our NPR release, as well as other places. Thanks.
Are there questions online?
Yes, Governor, we have a question from Claire Bisseka from Financial Mail. What will it take in terms of CPI, inflation expectations, the RAND, and the Fed behavior for the SARB to be able to stop the current hiking cycle? That's the only question, Governor, for now. Thank you.
That's easy. We don't watch the Fed, what the Fed is doing. And in terms of all of these things that you have mentioned, it's all of the above. There is one thing that is clearly guiding us. What would stop the hiking cycle is a clear evidence that inflation has not just peaked, but that inflation is declining sustainably to the 4.5% midpoint of the inflation targeting range. When that is, we will see. The point here is that we have taken a series of policy adjustments, and those policy adjustments are starting to feed through into economic activity and should feed through into the price formation process. And hopefully, as data comes through, we will see more evidence that it is having effect. And if it is not having effect, we will recalibrate policy until we are convinced that inflation and inflation expectations are now anchored at the 4.5% level. Any questions in the room?
Hello, Governor. Rachel Savage from Reuters. Were you and the other MPC members surprised by the inflation print earlier this week? And factoring in the inflation rising, do you expect inflation to continue rising, or is this just a monthly blip?
Thank you.
Thank you. I just want to clarify Chris's response regarding the steady state. Is it fair to say that the model, while we know it's just a broad policy guide, for now assumes no increases in the repo rate beyond 7%?
Online?
Yes, Governor, we have a question from Atol Dlamini at Alliance News. It's 2 questions. The SARB is monitoring funding markets for stress. What is your assessment of conditions in funding markets at the moment? Is there any stress that you are seeing against the backdrop of high volatility currently? The MPC sees recession risk in Europe. You don't seem to be expecting a possible global recession. And is SA at risk of a recession? Thank you, Governor.
Thank you very much. Rashad, I hope you are not stressed and you can deal with the question on the markets. Kuben, if you have got an appetite for global recession, I will give that one to you too. Question about the inflation, did it surprise us? Yes, it surprised us. We expected 7.3. I know the market expected 7.4. And so it was not in line with our forecast. It is still below what we believed to be the peak. But we will continue to watch this. I think that the key surprise for us had been the pace of food prices. And when we look at those food prices globally have gone down in dollar terms. So it was very much an exchange rate story. So when earlier on I talked about some of the risks that we identified at the September meeting materializing, that was one of them materializing. Prinesha, the 7% neutral is a nominal rate. And you might reach nominal neutral rate. What matters is what is the neutral real rate. But remember, neutral works to the extent that you are in steady state. And in steady state, that means that you then have a situation where the policy rate could neither lead to an acceleration of inflation or the economy dipping below its potential. But it could also be that you are at a neutral nominal rate, but the inflation is threatening or is continuing to rise, or could be rising going forward, in which case you might decide to go above neutral, in which case you are into tighter territory of your policy stance. So we are not yet in the tighter horizon of our policy stance. Rashad and then Kuben.
Thank you very much. Yeah, look, I think that there are various ways one can skin the cat in trying to determine exactly what funding markets you're worried about. Are you worried about dollar funding markets? Are you worried about rand funding markets? We use a term which we call financial conditions, and that means that sometimes we may be loosening or tightening monetary policy at the repo rate, but other markets can go in different directions. So, sure, there's lots of volatility in the markets. Now, volatility could mean one of two things. One is that volatile markets doesn't necessarily mean that there's a problem in the market. It's a normal part of price discovery. But sometimes when the threshold of volatility goes up, then one gets worried. So all of us sit on the Financial Stability Committee. So when we look at monetary policies, we constantly look at whether there's stresses in the funding market. There are a few issues, for example, when the yield curve goes up in this economy, the long-term government bond yield curve, that means that it's a bit more stress there. The cost of borrowing increases. When the rand depreciates, those who require dollar funding experience a bit of pressure. But I don't think at this stage, we worry. We always worry as a bank, but I don't think there's something special that is uppermost in our minds that if we did, we would have flagged. But I think, the fact that capital is flowing out of emerging markets given global monetary conditions is something that we monitor very closely. Thank you.
Thanks, Chair. Chair, the IMF says that there are elevated risks of global recession. That doesn't mean there will be a recession, but they do think that the risks of a global recession have increased. The IMF's GDP forecasts go from sort of 6% last year in 2021, which was very much a COVID rebound, to 3.2% in 2022, before declining to 2.7% in 2023. The IMF predicts about a third of countries will see economic contractions over the course of the next 12 to 18 months. That's a significant proportion of the world. There are different reasons in different regions, right? In Europe, it's clearly an energy issue, a negative terms of trade issue, supply disruptions as a result of the war, but also the impact of high inflation on the economies. In the US, the recession risk is lower. The US economy is doing pretty well. And the general consensus view is that the US is likely to avoid a recession. But again, as the IMF says, that there are elevated recession risks. China is interesting because China slowed down a lot in the last 3 or 4 months, largely as a result of its response to the COVID pandemic and its own housing market. Government has taken steps certainly to spur up the housing market and to invest in infrastructure to try and minimize the chances of slowdown. So our base case is that there probably won't be a global recession, but there are certainly elevated risks of recession. Now, how do monetary policymakers think about global recessions, and how does that affect our own thinking and our decision making? Our primary mandate is to achieve price stability, and we would have to do what it takes to get price stability. And that essentially means that we would do as much as we can to get inflation on a downward trajectory, a sustainable downward trajectory. But at the same time, you want to do that while minimizing the negative impacts on the economy. And there's a balance to be struck there. But the primary mandate of central banks is price stability, because that's good for longer term growth. Thanks.
Anything online?
No, Governor,
And
nothing.
nothing in the House? Thank you very much. That concludes the proceedings of today. In the statement, at the back of the statement, we have also spelled out the dates for next year for the MPC. Other things being equal, we will see you physically here in January.